bit of green on the indices actually flitting in and out, so not giving you a very proper direction at this point in time. So let's concentrate on the capital goods space. There are multiple directions over there as well. The GDP numbers indicated that capex growth, gross fixed capital formation, has grown by 12.2%. I think the best number we've got in 3 or 4 years. And yet, if you look at the CMI data, it indicates that new projects are at somewhat 14-year lows in terms of fresh starts. Where is the truth, really? M.S. Krishnan, Managing Director of Thermax, joins us. That's the first question, sir. Is the truth that there are good capex orders, like L&T's orders seem to indicate, your own numbers seem to indicate, and the GDP numbers? Or is CMI right that there's nothing new starting?
Well, Lata, maybe there is a stagnation period expected for 1 or 2 quarters for the larger projects. Otherwise, order intake for the capital goods industry had been fairly positive for the past 3 to 4 quarters. It's not going to go down for the next few quarters. However, in the larger sectors which are related to the government spending, and the infrastructure may see some stagnation for next 2 to 3 quarters. But the private capex is continuing, irrespective of whatever could be the outside talk. In my understanding, generally, many things are positive at this point of time. The big worry about the crude oil price, which could have impacted our fiscal deficit, is well under control, coming down to 50s and possibly stabilizing at early 50s. And Indian rupee is stabilized by a 4%, almost at 69.8. And on top of that, the inflation is fairly well under control. So the macro factor seems to be playing in favor of investment climate. But only uncertainty could be the political one, which may impact the larger capex for a short period of couple of quarters. But otherwise, I'd be positive about it, but not bullish.
Okay. Mr. Krishnan, I think the entire market is trying to figure out whether these green shoots are actually for real this time around. It's not another sort of, dud start. We had a guest with us who just told us that when cement volumes, for instance, cross 10% growth in cement volumes, then you can say that this is the real thing. For the capital goods space, what would you say? I mean, for your own growth, for instance, for the year as a whole, what kind of numbers? And how do we ascertain if this is the real pickup in capex?
Well, Thermax will grow in the current year and will possibly grow in the next year also, but that cannot be the bellwether for the entire industry. There are sectors in capital goods which are related to construction and automobile and maybe machinery are doing very well. In any case, all construction companies are doing extremely well because the number of projects already announced and taken up by the government, both center and state, are fairly large. So there will be a ripple effect of that in the cement industry also going forward. So my expectation is the private capex is continuing to be happening in the positive direction, the order intake and the inquiries floated in the market, but mid-sized projects are fairly positive. And that is continuing irrespective of whatever is uncertainty prevailing in the global macros or maybe the domestic political uncertainty. There is nothing like, for example, if we were to take automobile industry, all of you do complain about past 3 months there had been possibly a decline, though in the recent past there had been a positive news. I'm aware of the fact that every tire company in the country is investing for new capacity, not small numbers. One of them have even possibly committed 15,000 crores investment in the tire manufacturing, one company alone. There are multiple of them coming in. And a feeder industry into that is a carbon black. Every carbon black company in the country is capacity expanding. So if we were to see it below the line where people are not noticing it, a lot more of investment is happening, targeting the consumer spending in the future, in the durable sector, FMCG sector, and also possibly in the auto sector, in my understanding. And this can support to a certain extent some sets of companies. But where are we lacking is a question you need to look at it. Nothing is happening in the power sector. The ordering has come down to maybe a 3,000 to 4,000 megawatt, as against a real demand of maybe a 4 times more, minimum 15,000. So there is a laxity in that area, which certainly will be impacting us in the future in terms of the electricity available as the economy picks up. Steel capacity, barring 2 of them which are already announced, I don't think there is anything going to be taking off in the immediate future. That will wait for the NCLT to be over and then fresh capacity, because most of the steel companies in India are running to the brim of the capacity. We need capacity to be created, otherwise we'll have to resort to importing. Oil refineries, I'm quite ashamed to say that despite all the requirement, of the kind of automobile growth happening in the country, there is no refinery investment. So these are the 3-4 sectors which eventually will open up. But I think it would take possibly a couple of more quarters for them to be coming to realize that it is time for them to be starting to invest also.
Okay. Mr. Unnikrishnan, therefore, how are margins panning out? We are seeing a fall in metal prices, fall in commodity prices as well. So although volumes, as you say, are riding only on one leg, that is private capex, would you be able to make up on margins?
See, the reduction in the commodity prices, if it is going to be panning out in the next few quarters, the impact that will be visible for our industry only a year down the line.
Okay.
Because most of the orders on hand for the capital goods industry is already covered with the earlier elevated price of the commodities. So the margins will continue to be under stress for the industry for maybe few more quarters. But the easing of prices will be beneficial for all of us only a year down the line. So you will continue to be seeing a margin squeeze in the industry, but it will improve going forward.
All right. So we are out of time. But thank you very much for an extremely enriching conversation. Several sectors are going to face capacity constraints very soon, like power and steel, but they will take a couple of quarters to realize that and fire up, maybe just as well, because by then perhaps the finance sector also would have come out of its blues. But clearly, private capex picking up, that's the word coming in from Mr. Unnikrishnan. We wrap up Bazaar on that note. Chartbusters ready for you with a lot of trading ideas. Thanks for watching us.